Welcome to Keys Open Doors. Today we're breaking down 30-year fixed-rate mortgages. It's an absolutely foundational topic for anyone looking to step into homeownership. So let's jump right in and look at exactly how these rates behave out there in the real world.
So if you've been looking at real estate lately, you know the terminology can feel, well, incredibly overwhelming. You hear stuff like mortgage averages, basis points, and APR, and it all sounds incredibly intimidating. But hey, I'm here to tell you, you absolutely do not need a finance degree to understand this stuff. Think of me as your personal guide. We're going to strip away all that heavy jargon and look at exactly what a 30-year fixed mortgage actually is in plain English, and how it directly impacts your journey to buying a home.
Okay, let's start with the absolute basics. What exactly is a 30-year fixed mortgage? Quite simply, it's a home loan with an interest rate that's locked in. It stays exactly the same for 30 years. That's literally it. Whether the broader economy goes way up, down, or just sideways over the decades, the interest rate you secure on day one is the exact same rate you'll have on day 10,000. Fun fact for you, the 30-year fixed mortgage was actually created way back in the 1930s to help stabilize the housing market during the Great Depression, and it's basically been the bedrock of American homeownership ever since. The absolute core word I want you to focus on here is predictability. In a world where prices seem to change all the time, this kind of loan protects buyers from future rate spikes. And this brilliantly illustrates why predictability is, honestly, your best friend for budgeting. I mean, think about it. Over 3 decades, the cost of groceries, gas, utilities, they're almost certainly going to fluctuate, right? But with a fixed-rate mortgage, your core monthly payment for the principal and interest of your home, it won't surprise you. Knowing exactly what your housing cost is going to be next month, next year, and 20 years from now gives you an incredible foundation for managing your household finances and building real wealth over time.
Section 1, Recent Mortgage Rate Trends. Between April 23rd and May 21st, 2026, we got this really interesting 5-week window, right in the middle of the spring home buying season. Spring is traditionally when the market is the most active, so this gives us a perfect real-time snapshot of the natural rhythm of mortgage rates week by week.
So over that month, there was a slight gradual upward trend. On April 23rd, the national average sat at 6.23%. 2 weeks later, it nudged up a bit to 6.37%, and by May 21st, it reached 6.51%. Now, notice it's not a massive, dramatic spike, right? It's more like a gentle staircase. And, this is exactly how rates typically behave. They just float slightly up and down based on broader economic currents that we really don't need to overcomplicate in this explainer today. Let's zoom in and focus on that final number for just a second, 6.51%. This spotlights the most recent national average rate from late May 2026, and it kind of anchors our current market reality. When you hear folks talking about where rates are at today, they're usually referencing a national benchmark just like this one. It's the baseline that helps everyday buyers understand the current climate before they start running their own personal budget numbers. So here's the crucial takeaway. Small weekly changes are completely normal market movements. Seeing the rate tick up slightly over a month might feel a bit stressful if you're out there actively house hunting, but I really want to reassure you that these upward or downward ticks are entirely standard. It's really just the market breathing. It is absolutely not a reason to panic or, worse, rush into a huge financial decision before you're truly ready. Section 2, Decoding the Percentages. Now, rate changes impact 3 main things. First off, your monthly payment size. A higher rate means a slightly higher monthly bill. Second, the long-term interest paid. Over 30 long years, even a tiny fraction of a percent really adds up in total interest. And third, your overall buying power. Now, this is the big one. If rates go up, the maximum loan amount you can comfortably afford might go down slightly. We're breaking this down not to scare you, no way, but to empower you with the reality of exactly how your wallet is tied to the broader market. To make this super concrete, let's compare those 2 anchor points we looked at earlier. 6.23% in late April versus 6.51% in late May. That's a difference of just about 0.25%. While that sounds incredibly tiny, over a 30-year loan on a typical home, that little fraction actually changes your buying power slightly. It might literally mean the difference between having a little extra breathing room in your monthly budget or feeling, slightly stretched. This is exactly why tracking the average matters so much. It helps you set super realistic expectations for your home search. Section 3, Your Home Buying Game Plan. So where do these national averages actually come from? Well, first, everyday lenders submit their application data. That data is then compiled into a major primary mortgage market survey.
Finally, those official aggregated numbers are updated in national economic databases, meaning the rates you're seeing in the headlines are grounded in actual, real-world loan applications, not just guesswork.
As you can see, the weekly mortgage rate is based on actual applications submitted to major national mortgage institutions. Because this is a huge national average, many buyers find real peace of mind in the predictability of fixed rates. But remember, your personal financial picture is completely unique to you. In general, you should always talk to a licensed local professional to see what fits your specific budget and your goals.
So, as you watch the market breathe this spring, ask yourself, is your budget really ready for your dream home, or are you still building your foundation? Keys Open Doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.